This is the Grain Farm Returns for 2021 and 2022 presentation for the Illinois Farm Economic Summits, the 2021 version. Thank you for being with us today. I really do appreciate that. My name's Todd Gleason. I'm your host for the morning, and I'm a farm broadcaster here at the University of Illinois. You can always find me online at willag.org. I have a daily radio program that talks about the markets and the weather. In fact, I talked to Drew Lerner this morning a lot about wheat across the planet. That's been driving a lot of what's happened with the price of corn in particular. So you'll want to hear that. You can find that at willag.org later today. Now, our topics for today for the Grain Farm Economic Summit will include grain farm income for this year. We'll talk about income projections for next year, cash rents, and the long run price and income outlook. Gary Schnicke will begin our process. Dale Latz will join us for cash rents, and Krista Swanson will take up that long run price farm outlook. All of them are part of the FarmDoc team here at the University of Illinois. Let's start off with a quick poll for the day. What is your projection of the 2021 grain farm income? Tell me whether you think it'll be significantly below average, near average, above average, or significantly above average. So that poll is now open. Take some time and click one of those very quickly. When we get to about 70% of you, we'll close the poll out. To begin with, we have a few less than 200 online with us. Sometimes people like to know how many are there. That number will continue to tick up, I know, as we make our way through the morning. So go ahead and finish that off. We're almost to 70% of the folks that are online that have voted, and there we are. We'll close that poll out. Here are the answers to that question. 5% think below average. Nobody thinks significantly below average. I think above average is interesting. 52% and significantly above average for this year. 52 and 26%. So what do we end up with there, Gary? So that's what, 78%? That's not too terribly bad. Gary Schnicke joins us. Good morning to you, Gary. Thanks for being with us. I suppose you'll go through some of these numbers like that today.
Yes, we will. And the 78% of our respondents, we're on the right track here. So we're going to start out with 2021 grain farm income. Obviously, we're still projecting that because the way this works is we typically we don't publish the actual numbers until we have the financial statements summarized from Illinois FBFM Farms, and that will happen in March or April of next year. So we're still projecting 2021 income, that process again. So last year, though, just to put this into some perspective, last year in 2020, we had $256,000 of income per grain farm in Illinois, and that would be per grain farm. That's all across the state. That would be an average farm size of roughly 1,400 acres, over 1,400 acres. We have farms that are very much smaller than that, and we have farms that are much larger than that. There's a couple 10,000 acre plus farms also summarized in that number. So $256,000 was the net income last year for 2020. That resulted from the increase in prices that occurred later in the year, the CFAP payments that happened in that year, and the above average above average yields. And that income was significantly above those from 2014 through 2019. So now in setting up what we're looking at for 2022, we're going to start here by looking at U.S. market year average prices for corn and soybeans. And this goes all the way back to 1960, just gives us a historical perspective here. As with prices, as we almost always mention, there's these long periods of reaching a plateau, and there's a lot of variability around that plateau, but still not trending up or down. From roughly 1974 to 5 to 2006, those prices averaged $2.38 for corn and $5.98 or $6 for soybeans. So then that was a period before 2005. And then we reached this newer, higher plateau that we're currently at. That was a result of continuing strong demand for soybeans in the export market, but also because of the growth in corn use and ethanol. And we've averaged 438 for corn during that period from 2006 on. And USDA is projecting a 545 price for the 2021 marketing year, or for that crop that was just produced. That looks to me like a good average price. We have prices above that currently, and so 545 seems like a good price for the 2021 crop. The soybeans averaged 1063 from 2006 on, and USDA, and again, we would be sort of looking there at that same price at 1290 for 2022. So, or excuse me, 2021. So both prices, 545 and 1290, are good, and will result in good incomes. Overall, on the yield side, we're looking at, according to USDA, above trend yields for 2021. USDA projected for Illinois corn, this is for the entire state, at 207 bushel per acre average. That compares to a trend of 186 bushels per acre, and we're 21 bushels above that for this year. So overall, the projections are for good corn yields in Illinois. That's obviously going to vary across the state, but there are areas where we have very good yields, and good yields combined with good prices are going to result in good revenue. That corn yield is going to vary across the nation. Generally, east of here will have higher than trend yields. Indiana actually has some variable yields, and the further west you go, the lower those yields tend to be. North Dakota, South Dakota, and Minnesota have below trend yields. Soybeans, 64 bushels is the projection for Illinois. That would be a record yield. 60.3 is the trend yield, so 4 bushels above the trend. So considering those two things, we're looking at above trend yield for 2021. That, again, combined with higher prices, will lead to very good revenue for 2021. So given those two things, we are projecting right now $325,000 revenue for 2021, which would be a record level. And again, you put high yields and high prices together. By the way, there are no ad hoc assistance payments in there, and there's no ARC or PLC payments. That is totally revenue. There likely be some crop insurance payments, small amounts across the state in areas where we did have low yield shortfalls, but that $325,000 of revenue is based 99% of that is from crop revenue, and again, good yields and good prices result in that $325,000 of projection. That's going to raise some interesting issues right now as we're looking at very good incomes, and many farmers will be trying to offset those incomes. So purchases of equipment is going to be very difficult at this point in time because of supply issues, and the input purchases are an interesting one. Dale's going through tax planning right now. What's the good advice here for tax planning?
Well, obviously, as we look at next year, and you'll get into this, Gary, certain costs, especially fertilizer, are increased quite a bit. And we have seen a lot of pricing already and payment for next year's input, especially fertilizer, to lock in prices. So that's a little unusual. A lot of times seeds paid ahead, and that probably will be again, but we're in a little different dynamics out there in terms of when you're going to have to pay for some of this stuff just to lock in prices. So that's a little bit different. I also quickly mention that producers may be thinking out there when we talk about no ad hoc payments considered in the 21 figure. We did have CFAP 3 payments that came out and received in 2021. But when we did do the analysis for FBFM, we did accrue those at the end of last year to the 2020 income year, as they were assigned really to the previous year. So even though payments were received this year, those were accrued in our analysis anyway to the previous year. We did see some extra WIP payments come out at the end of this year that probably wouldn't have been accrued. So there'll be a little bit of that in there also.
Yeah. So all of that, again, setting up that $325,000 of income. So now we're going to move to the price and cost outlook for 2022, and there we'll get into those higher prices or for inputs. And if you have any questions or comments as we go through this, make sure that you submit those in that chat box so that we can hopefully attempt to answer those. Beginning here, though, let's start. Currently, fall 2022 bids for corn are above $5. And so we want your expectation for next year. What do you believe are for 2022? And we're going to put this, we're going to have a normal crop. We're not having a drought year. We're having a normal crop. What would you expect prices to be at this point in time? We asked the same question last year, and just to give you a feel for this, so this would be last year's question. And what did you all say to that? You said last year above $4, so which is where we're at. Only 13% thought we would be above $4, and 82% thought we would be between $3.50 and $4 for this coming year. So, as it turns out, we were not that good. So. And again, setting this up.
So I was going to say, Gary, that shows the value of these polls. Right?
Yeah, which we were a bit pessimistic, but setting this up, obviously 2022 income is going to be contingent on what those prices are. Here's what you're thinking those prices are. 51% of you think they're roughly $4.75 to $5.25, roughly where we're at currently. So most of you are in that range of above, about where we're at currently. 11% above, and then 40% or 39% of you are below. One more question. So that was corn, and basically saying that is 5-ish. Where we're at now would be what this poll voted. We're now going to ask you about soybeans. So take a little bit and think about where you think soybeans are at. And again, we're going to make projections here for income for cash bids, where they're at, and then we're going to look at some of the scenarios that other individuals are talking about. I didn't manage to look up what we all thought soybeans were going to be like last year, but take a minute, and here we're almost done. We're going to close this poll here. And here is what our participants are saying. So 50%, 11.25 to 12.25, roughly where it's at now, maybe a little bit lower. 34% think it's going to be lower, and 12% think it's going to be higher. So roughly staying where it's at. You're all very good at market expectations being rational, or where the future market says that they're going to be. The one thing that we do know, we may not know where prices are going to be, but we do know where costs are going for next year, and they're going considerably up. Our projections are now for cost of producing corn to be $747 per acre. That's up considerably from 20 and 21 and any other year for that matter. Roughly, it was $600 for the last 3 years, so we're looking at $150 of higher cost for this coming year for corn. We would be looking at roughly the same amount of cost increase for soybeans on a percentage basis, so both of those crops are going up. All costs are going up, so you can't pinpoint one and saying that this is the one that is going up and the others are not going up. All of those are going up, but the one where we're seeing the largest increase is in fertilizer prices. And here is a look at where fertilizer prices are currently. Last check we had was in November, late in the month, November 18th or 19th. At that point in time in Illinois, we had a $13.43 average anhydrous ammonia price. We see some reports of that being over $1,400, but you can see that has gone straight up here in recent months. And we were last year at this time in the $4.50 range. So $4.50 to $13.43 current bids is where we're at. Having said that, 1343 would be where we're at currently with current bids. Many farmers did book nitrogen earlier in the year, $700 to $800 per ton range. And most of those bookings would have to require that nitrogen being put on in the fall. If you haven't put it on yet, I know you don't need this advice, but get it on if you possibly can. DAP and potash, DAP is at $825 per ton, up considerably, $887 per ton on potash. To give you a feel for what that is going to do to fertilizer cost, we calculated fertilizer costs using prices on 2021 and 2022. We're going to do this both for corn and for soybeans, going through anhydrous ammonia, DAP, and potash. So we're first going to start this with corn. And you'll note that there's two numbers in there for anhydrous ammonia requirements per acre. 234 would be for last year. 207 is the application rate for this year. The 207 is lower. We use the MRTN corn nitrogen rate calculator to calculate these because anhydrous ammonia prices are up considerably. This model would suggest applying a much lower rate. In any case, and all of those models would suggest that. So lowering, in this case, anhydrous ammonia applications went down roughly 30 pounds per acre. I would also note that many farmers apply above rates suggested by these models. And this year, that is going to be very costly. So thinking about moving back to those MRTN rates likely would be a good move this year. And again, those MRTN rates result in the most economic profit and are generally very, very close to the maximum yield. Given those requirements and last year's prices, which were 432, and we took these on October 22nd, 432 for anhydrous ammonia, 428 for DAP, 327 for potash. We had a $94 per acre fertilizer cost. Those DAP and potash applications are at replacement values, so that's replacing the crop that the crop needs for that case. Soybeans, $46. So that was last year. Now let's look at this year. Prices on 10/21/2021, $1,400 for anhydrous ammonia, $850 for DAP, $887 for potash. That results in a $232 per acre cost. So that's gone up considerably, close to $140 per acre. I would also note that if you look at these prices, the way we're calculating those and compare those to what is reported in FBFM, these are typically lower than what's reported in FBFM. Lime is also included in fertilizer cost and FBFM costs. So if you're looking at our budgets, lime would be included. And also many farmers use 28% on for their nitrogen needs. And 28% will almost always, 99% of the time, be a more costly form of nitrogen. Soybeans, $106 per acre for fertilizer cost, and $138 for change from last year, and $60 a change for this year. So we're looking at considerable differences in fertilizer cost from this year to next year. Again, all cost categories are going up, but the most shocking, I suppose, is fertilizer this year.
Here, just one comment on that. We know some people have booked prices probably down the line, maybe in between those two levels, in terms of fertilizer. And I suppose another way of looking at that is if you got stuff booked 3 or 4 months ago, kind of halfway in between, you could just about cut that increase in half and maybe say instead of 232, I might be, $70 an acre higher, maybe $170 an acre or something like that.
Yeah.
For corn as an example. So it's going to be in between there sometimes, for some people anyway.
Yeah, we are going to see varieties of nitrogen cost across farms, and that will will have a lot of impact on whether corn or soybeans is more profitable. We took these latest cost estimates and put them in our budgets. You'll note here we're put in fertilizer at $262 per acre. We upped it to account for lime and a typical relationship, and $111 for soybeans. And again, we're showing corn and soybeans. We have yields in here at trend levels: 220 bushels for corn, 68 bushels for soybeans. We're putting in $5 for corn, $12 for soybeans, which are close to current fall bids. If we look today at fall bids, corn would actually be a little bit higher at $5.20, and soybeans would be a little bit lower at $11.85, $11.90. So these are close, but corn would be $5.20, $11.90, and you see the revenue there. Going through those rest of those costs, we come up with the operator and land return of $353 for corn, $356 for soybeans. So right now, it's about a push between corn minus soybeans. So even though we are looking at very high fertilizer cost, we still see corn and soybeans being roughly the same profitability. Again, if you had those prices or for fertilizer booked earlier, this 262 could be considerably below that. So this gives you a feel for this. Here is our advice. We would suspect that corn and soybean prices are going to be more tightly intertwined than usual, particularly up to planting. So if you look at changes in fertilizer prices, those are probably also going to be reflected in corn prices and soybean prices. So fertilizer costs go up, we're likely to see the difference widen between corn price and soybean price. And that has actually been happening in recent weeks. We've seen corn go up and soybean prices go up less and even come down. The market is telling you that they need corn acres and to plant corn. Having said that, that relationship could, more likely, will go away once planting has occurred. Once planting has occurred, April, May, it's going to be weather and conditions that determine the relative prices. That leads us to this suggestion. If you're going to plant more soybeans, you might want to price those additional soybeans. So if you're going to plant 10% more acres of soybeans as a result of these higher fertilizer prices, you might want to price those as well. We're looking right now at $11.80 soybean price. That would be a very good price. And so pricing those might be a good idea. On the other hand, if you're buying expensive nitrogen, you might want to price that corn that's associated with it, because we're looking at $5.25 for corn. So if we're betting on, or we're going to be buying $1,300 per ton of anhydrous, let's price some of that corn. And overall, you might suggest considering pricing more than usual for the 2022 crop. So looking at that, pricing more of that because we're looking at good prices. Typically by spring, we see 33% of the corn and soybeans hedged. You might want to be higher than that this year. We will be talking more about that and giving more detail on that on our this Friday's webinar. So if you want to hear more on that, come here this Friday and we will tell you more about what we're thinking at that point in time. Given that, here is what that corn and soybean projections look like for this coming year. Again, roughly equal. In recent years, from 2014 through 2019, 2020, soybeans were more profitable than corn. Last year, we're projecting corn to be more profitable than soybeans, and right now, looking at those two crops being a push. So, given that, we're going to make some projections for incomes for 2022. So again, we started out at $325 for this coming year, and we're going to give you three projections. First is $5 corn and $12 soybean prices, and these would be at trend yields. So close to our average yield in central Illinois, that would be 220 bushels per acre. Across the state, 207 bushels per acre. We're using a $5 corn price and a $12 soybean price. Given those price increases, we would be looking at $130,000 of net income per farm. That would still be a good income. It would be close to the average, or it would be, above the average from 2014 through 2019, when we had close to $75,000 to $80,000 of income. But I suppose the big point of this is that a $5 corn price and a $12 soybean price, which would be very high compared to what they were in recent years, are needed to get that $130,000 of income. Next, let's run this with a $4.80 corn price and a $10.50 soybean price. This is actually what USDA is currently projecting for the 2022 year. That results in $57,000 of income. Here, you'll notice that they're projecting a much lower soybean price than the current market averages, 12 to 10.50. So they're building in a decline in soybean price, and if we see that, we then see that those incomes fall to $57,000. That also is why, if you're thinking about planting more soybeans, you might want to hedge those soybeans right now. By the way, that doesn't necessarily mean that soybean prices are going to go down, but we're looking at very good prices, at least from a historical standpoint. So locking in those might be a good idea. Then last Monday, Professors Irwin and Jansen gave their projections of $4 corn, $10 soybeans, and that's not a good scenario. This was not their projections. This is 4 and 10. I'm sorry, 4 and 10. Take back what I said about that. 4 and 10 is what
4 and 11.
Was what they used. 4 and 10 are close to the average from 2015 through 2019. If we go back there, we would have minus $65,000 of income, which would not be a very good situation to be, and there would be cost reductions associated with that. So summary here, income's likely at record levels in 2021. Given current 2022 prices, fall bids, will be down from 2021 given trend levels. Corn and soybeans have about the same relatively profitability right now. And we would suggest thinking about the corn and soybean decision in a longer run context, not maybe making large swings in acres this year, but over time, we've seen soybeans more profitable than corn, and taking that into consideration. Dale is now going to talk about cash rents.
Thank you, Gary, and good morning, everyone. Again, as we talk about incomes, we want to touch on cash rents a little bit. At this presentation, I'll also mention that Bruce Sherrick will be doing a farmland value webinar on Monday, and I think he'll be also touching on cash rents at that webinar, and he'll probably come at it a little different way than what we're talking about today, but we'll kind of mention and touch on this a little bit. Obviously, we're in a time period of changing farm incomes, higher farm incomes after a few years of kind of lower and steady income. So that does have an impact on cash rent and cash rent levels moving forward, at least in the next year or so. Before we get into some of the slides, we'll just take a quick poll here. Question is, how much do average cash rents do you think will change in 2022 compared to 2021? I'll just add that in there. Probably ought to increase those dollar per acre figures a little wider than what we have there. But anyway, we will wait here and see what our results come in. As we get close to 70% or so of the poll in, we will shut her off. But again, how much do you think cash rents will change for the upcoming year compared to this year? A lot of those rents have probably been negotiated already for next year. Some still have to be negotiated. We're kind of in the middle of that season right now, or maybe past kind of that. So let's look at the results here. If we bring those up, we can see only 1% said decrease, which we'd probably understand with what we're talking about in incomes going at the other end. Looks like 40% are saying up $10 to $20 per acre, and 22% about a fourth or a fifth or so up over $20 per acre. So I think, again, with the income levels we're talking about, we're going to have pressure on cash rents moving up as we would expect. So as we look at this first slide, this was something similar that Gary had touched on. This has a little different twist to it. This is operated land returns and cash rents on the highly productive farms in central Illinois through with 21 and 22 being projections. I believe Carrie's slide showed this for kind of each year broken between corn and soybean returns. This just has a blend of these returns. And so you can see again, as Gary had mentioned, we had the 4 or 5 years after the high income period from 14 through 19 or so of lower returns. That red line, that red bar that goes through there is kind of an average cash rent on these higher productive farms. You can see again that green bar is return to the operator and land. So if we subtract out that cash rent figure from those returns, that would be the return to land, and what would be left over would be the operator return. Obviously in 14, 15, 16, 17 time period, they're about the same, which means those returns covered our cash rent period, but basically little, if anything, left over for an operator return. So we want to have that green bar above that cash rent line by a fair amount, $50 to $100 an acre or something like that, we would hope for. And you can see in 20 and what we're projecting for 21, that is the case. Obviously in 20 already we had higher incomes, some increase in prices, but with a lot of the ad hoc federal payments. And again, I'll mention that for the analysis purposes, we did accrue the CFAP 3 payments that came in this year. I believe those were around $20 an acre received in 21, but those were accrued to the 20 farm income, as that was the income year that they were kind of based on or paid out for. And you can see kind of the jump as we're projecting for 21 in farm incomes. As Gary had touched on this quite a bit already, good yields, real good prices, and haven't had the big increase in fertilizer costs or other costs for 21 yet as compared to what we're projecting for 22. So again, we're expecting other costs to go up along with cash rents for 2022, and you can see the drop in returns compared to 21 and 20. If we kind of move forward here, let's see.
I'm getting there.
We're getting there.
All right, go.
There we go. Okay. So we get a lot of questions on cash rents and some of these slides. If you've been with us in previous webinars, you've seen these before, but we'll touch on these quickly again. USDA, the National Agricultural Statistics Service, does put out figures every year on cash rents for the different states around the country. You can see here's the average rent for the 3 I states in the Middle West here, Iowa, Illinois, and Indiana. Again, I kind of look at this just as an idea of giving me maybe a trend of where things are going. This is an average for the whole state, so you've got various qualities of land in here. So that figure in itself probably doesn't mean necessarily as much, but the trend is probably what we're looking for. And again, after we had the high incomes in the 2006 through 2012 period or so, we obviously seen an increase in rents. Then the drop in incomes resulted in rents kind of coming down actually a little bit and being very stable the last 4 or 5 years, as you can see there. On average, Illinois in 2021 was around $227 per acre. Another source, again, from the National Agricultural Statistics Service, about every 2 years or so, they actually put out a publication with average county rents on surveys that they take. And this was done in 2021 and released, I believe, in August or so. You can get this information from NAS, or Gary has put out a farmdoc daily, I believe, on this information back a few months ago also. And as you look at this map of Illinois and the different counties here, you can see the darker green areas are the higher rents, and as we go to the lighter green or the white or the red would be the lower rents. A range in the state from $52 of a low in southern Illinois up to $311, which is actually Macon County was the highest when this survey was for this survey done in 2021, and the counties around Macon were generally right there and close to that $300 range, 290 or so. And we have a couple other areas, Western Illinois and Northern Illinois, with good soils that also have kind of the higher rents, maybe not quite as high as Central Illinois, but still good rents in the $260, $270 area. So this is another source to kind of give you an idea. Again, this is an average rent. There's a lot of variation between, among rents, and it's fixed rent and a variable rent and things like that. But this is another source that's available out there to kind of get a feel of what's been going on. Another source, the Illinois Society of Professional Farm Managers and Rural Appraisers, does an annual survey of farmland values and cash rents. That survey is conducted in the December-January timeframe and released in March of every year. So this would have been released last spring. We also have a kind of a mid-year update on that in the summer survey. But you can see they've broken down the quality or productivity of land in 4 general classifications: excellent, good, average, and fair. And you can see for the time periods there going back to 2008, these would be the midpoints, I believe, of the results of those surveys. And again, you can see for the excellent quality land, the last 3 or 4 years, we've been around that $300 per acre area. It did come down. We actually peaked almost close to $400 after that high income era, 2006 through 12, that we talked about, and dropped about $100 an acre from the top on that excellent farm ground. As we look at 21, we did see some increase a little bit. Of course, 21 rents negotiated probably in the fall of 20, kind of before we had the big price movement yet in corn and soybean prices. You can see what we're projecting in 22 now, where we kind of know, or we've been in a period of a year or so of higher prices. Anywhere from a $20 to a $35, $40 per acre average increase in rents for this upcoming year for 22 compared to 21 as a result of these higher grain prices. So again, another source of information that can be used as a resource in looking at what rents have been or what we're projecting. Again, this is the same information, just charted out on a graph here. Again, kind of showing graphically, the increase in rents after that higher income period up to peaking out in 2013. And then as farm incomes had come down, we did see generally a decrease then, did see a decrease over time following the drop in farm incomes to about 2017 or so, and then been stable since then until recently now. As farm incomes increase, we'll see movement back up on these rents. Another source that we look at to do a little bit of research on is based on the FBFM records on grain farms. We can kind of look at what returns and costs have been in different cost categories on these farms. And if we kind of figure and using a typical 50-50 crop share lease and look at what returns a crop share landlord would be getting on gross returns, less the expenses that they would have been paying, half the fertilizer, chemical, and seed and so forth, kind of looking at their net rents on crop share leases and then adding back what they would be paying, a landowner would be paying if he was cash renting that ground, and that basically be adding back real estate taxes would be the main one added back to that net rent, plus a little bit for insurance and some building costs. We can kind of get what we call an adjusted net share rent, or another way of looking at that would be an equivalent cash rent. So this figure, or these dollar amounts, you could think of those as what if I was receiving as a landlord or paying as an operator, and basing that cash rent on what returns have been on crop share leases. This would be what that dollar amount would be. So you can kind of think of this as a cash rent figure if I was determining that cash rent figure based on crop share returns. And again, you can see after the 2011-12 period, kind of the end of the high incomes, how high we got. Obviously, crop share leases adjust annually right away in terms of changes to yields, prices, and input costs. And you can see the downward movement as it came back down. And then we've had a little bit of a movement back up here, kind of a drop in 2019. But as we looked at 20 returns, those are actual figures. You can see we'd be up to around a $300 acre. We have these divided out in northern, central, two kind of two sections or two groups for central Illinois and then southern Illinois. And you can see the northern and central high soils that would refer to would be a little bit over $300 per acre in 2020. We talked about what a return or a cash rent would be based on what the old typical crop share leases would be. So that's another kind of barometer. I use this a lot to kind of get a feel of what the economics would dictate for cash rents based on a crop share lease. Some of our variable leases, variable cash rent leases, are based on a percentage of the gross. This takes that adjusted net share rent, and then this divides that over our gross crop returns for each year. And we just kind of figure what a percentage of that would be. And boy, I know going back in time 20 or 30 years ago, some of the land economics professors would say, about a third of your gross, at least for northern and central Illinois, is kind of what the land cost is or could be. And that really plays out in time, even in the current economics here. You can see that obviously that fluctuates quite a bit from year to year, but if I do about a 10-year or 15-year average, at least for the northern and two central areas, we're right around a third of our net share income, if you will, on crop shares is about a third of what the gross would be. So that gives us, again, some barometer if we're looking at paying a percentage of our gross for cash rent. And I know there's a number of them out there that are based on 34, 35, maybe up to 40% of the gross, depending on corn and soybeans in the area. But this is another using actual data kind of configure or confirm maybe what that percentage would be if we kind of equate that back to crop share returns. Looking at taking this adjusted net share rent, and then also comparing to what the Illinois Society's cash rent had been on excellent productivity ground, it kind of gives us an idea and just kind of confirms that as we see increases in fixed rents over time and then have a period of lower farm incomes, these fixed rents seem to adjust fairly quickly when incomes are moving up. And you can see in that 2009 through 2012-13 period, both the net share rents, and remember, net share rents are going to really adjust every year to what the economics would say or result in. These rents, these fixed rents, some of these would be probably flexible rents also. They also adjusted very quickly up as farm incomes went up. And we had times of lower farm incomes for an expanded period of time, as we did from the 12 to 13 time period through recently 18-19. You can see obviously that the adjusted net rents are going to come down right away as they result in or are a reflection of what's happening out there in terms of the economics. The cash rents, the fixed rents do come down, but they come down at a slower pace, and kind of see the gap there between the two. And we did see those excellent productivity rents come down from a peak of almost 400 to 300, about $100 an acre drop. But that took 5 or 6 years for that to happen, of lower farm incomes, before then they stabilized. It's interesting to look at 2020 time period. Both would be at about the same level, given what happened there, where we had higher incomes, which weren't reflected in the cash rents yet necessarily, but obviously were reflected right away in the crop share or the adjusted net rent figures. Just kind of summarizing some things here as we kind of touch on cash rents. As we talked about here, after 4 or 5 years of steady rents, higher farm incomes are going to be pushing cash rents higher. Rents on flexible cash rent leases, and when we talk about cash rent leases, some of those are fixed. We do have quite a bit of flexible or variable rent leases out there that do have clauses in them that look at what yields and prices have been for that current year, and usually include some kind of base payment plus a bonus, depending on what returns are. And those would have been actually adjusting already in 2020 when we had the higher income. So there was some cash rents out there that with the flexible clause in them that would have made some bonus payments in 2020. As I mentioned, fixed cash rents do lag in their adjustments, just because they're negotiated usually a year or so ahead of what actually happens. And if we've had a period of stable incomes and all of a sudden down the road things start increasing, it's going to take a few years for those fixed rents to increase. And we'll see that larger increases obviously coming up in 2022 here, after we've had a year or two of better incomes. I kind of mentioned this and threw this in here, and I've heard a little bit of this as a kind of a strategy out there. Farmers with fixed cash rents, as they negotiate rents for 2022, instead of just looking at a significantly higher rent for 22, being asked by the landlord, may want to consider kicking in some bonus payment for 21, even though it wasn't in the maybe terms of the fixed cash rent lease, but realizing if they had a good year on that property of kicking in an extra payment above what the fixed rent would be to kind of offset maybe some increase in what a landowner might be looking at for 2022. Just thinking ahead as we look at 22 and we have increase in rents, but costs are going to be quite a bit higher. We could be in that revenue cost squeeze down the road here sooner than we think. As I mentioned, fixed cash rents generally go down slower than they go up. We kind of seen that there illustrated. And another thing to think about as we continue to review, I would continue to review terms of variable cash rents as farm input costs increase. Sometimes I think we get lulled into sleep and thinking that we have a flexible or variable cash rent, and we have those terms in there, and that might work well on the revenue side, where we look at most of those bonus rents or variable rents are going to be looking at the revenue side. They look at prices and yields and some base. Well, as we see this significant increase in farm input costs, if that percentage is 35 or 40% of that revenue, and we don't take in consideration some of these cost increases, we may want to consider dropping those percentages of that gross as far as in the variable rent clause calculation due to significant farm input costs increases. So again, just keep that in mind even though you have a variable cash rent, that still needs to be reviewed once in a while from time to time. Okay, that kind of summarizes up. We will answer a question or two.
We had one question here about the land qualities, which we will take. So Dale was showing the land qualities by the Illinois Society: excellent, good, average, and fair. And they do not correspond strictly to A, B, C, and D land. The productivity in those land categories are based on soil productivity indexes. And just to give you a feel, if you're above 133, you're excellent. 132 to 117, you're good. 116 to 100, average, and less than 100 is fair. That will be close to those A, B, C, and D, but it isn't the same. So,
Gary, I don't know if you have they also put out a range on corn yields tied to those. I don't know if you had brought those up.
I don't have that in front of me right now. We'll need to do that.
Yeah, and just as a reminder, because you did answer that question, if folks have questions, they can ask them easily enough. They just look into the question box and they can ask questions of us, and we'll get them answered. I won't, but Gary and Dale and Krista Swanson. Well, speaking of Krista, she's up next with some long-run price and income outlook. I think you're going to start with, this 5 years from now, will corn prices average poll. Why don't you run through that for me, please?
Yeah, we're going to start out this section talking about long-run prices and income outlook with a couple polls. So first poll is 5 years from now, will corn prices average either below $4 to $4.75. Well, I guess we already have, it looks like we have the results up, so I will continue reading those. It looks like the majority of you are saying, we have 38% of respondents saying between $4 and $4.75. Looks like the next highest bucket is $4.75 to $5.25. So majority are in that range between $4 and $5.25, and it looks like just 10% say below $4 and 7% above $5.75. And here in a minute, we'll look at what USDA actually has to say about that. Now we have a soybean price poll. So 5 years from now, will soybean prices average below $10.25, $10.25 to $11.25, $11.25 to $12.25, $12.25 to $13.25, or over $13.25. Looks like we've got results up now, and it looks like about a third are saying 10.25 to 11.25, and close to another third are saying 11.25 to 12.25. So it looks like we have, about 2/3 in that range from 10.25 to 12.25. It looks like only 10% stay below 10.25. So some of you may be surprised to see what USDA has to say as we look at that here in just a second. So the USDA puts out long-term agricultural baseline projections in a full report in February every year, but the data is released ahead of time in November. So this projection period is from that early release for the upcoming February report, just came out last month. And these projections include farm level prices for corn and soybeans. So we're going to look at that. If you look at soybeans in the green, USDA is projecting $10.50 for a 2022 price. And then you can see that that gradually drops over the next few years after that. And then for the remainder of that projection period decade, the price is around it's at $10 for the rest of that. So this graph also shows historical soybean prices going back to 2005. And in that time, soybean prices varied from under $6 to over $14. But the average price between 2005 and 2020 was $9.92, which is shown here as that green dashed line. And so what's interesting about USDA's long-run price projection at $10 is that it's basically the same as that 15-year average price from 2005 to 2020. And I think now I don't remember the percentage that was just up on the screen a few minutes ago, but I think there was less than 10%, was it 7% said under $10.25. So as you can see here, USDA's projections are in that very low $10 range as we look out 5 years from now. And so looking at corn, we see the same pattern. Corn here is in the orange line. Jumping ahead to 2022, you can see $4.80 is that 2022 price. And then USDA, just like with corn, we see a gradual drop over a couple years. And then for the remainder of that decade projection period, USDA has the farm level market year average price at $4 for each of those years. And again, just like with soybeans, we see that long run price that USDA is projecting is almost exactly the same as that 2005 to 2020 historical average price. So the orange line on this figure is exactly the same as what was on that previous slide, but now we have also added historical and projected operating costs in that maroon line. And this isn't the total cost of production or total non-land costs. It's some inputs and other variable costs of production like fuel, utilities, repairs, and labor is what's included in this operating cost figure. And you can see that operating costs kind of increased from about 2005 to 2015, and then have kind of been at a plateau level since then. And USDA's long-term projections show that level continuing, staying relatively flat into the future. So I scaled these, I guess I should also mention that there's a maroon dotted line that represents that 2005 to 2020 average operating costs, similar to what we did with corn and soybean prices on the last slide. It may be a little hard to see because it's almost on top of that orange dash line for corn. And those were scaled the same on purpose. So we could look at that relative, the relative level in the projection period for the price side and the cost side. And we can see how we already talked about how price in the long run is almost the same as our historical average. We can see that costs in the long run projections are above, they're about $25 an acre higher than that long run historical average, excuse me. And then if we go to the next slide here, we can do the same thing with soybeans. So again, that green line and green dash line, those are the same as the first slide that I discussed. This operating cost line in the maroon is soybean operating costs. And we did the same thing here as we did with corn. So scaled those so that 2005 to 2020 average was at about the same level on the graph. And just like with corn, we see here that our average operating costs in the projection period are quite a bit higher. For soybeans, they're about $35 an acre higher than our historical average. And the takeaways here as we flip to the next slide is our long run projected prices are basically equal to our 2005 to 2020 historic average prices for corn and soybeans. Our long run projected costs are greater than the 2005 to 2020 historic average for soybeans. So when we think about where we've been on this relative level of costs to prices, what does that mean in terms of income as we look ahead to future years? So as I was just saying, that relationship between future prices and future costs is kind of concerning. And so to get an idea of what that means in terms of income, we applied some of the takeaways from those USDA projections and applied it to the farmdoc budgets for Central Illinois high productivity land. And the title on this slide says 2022 long run income scenarios, but really this is it's kind of using 2022 as a starting template to consider some scenarios for future years. So some of the cost figures differ slightly from what Gary talked about earlier. It's intended to reflect a future year. So at the baseline level, we are using 220 bushels per acre for corn and a 68 bushel per acre yield for soybeans, and prices of $5 per bushel for corn and $12 per bushel for soybeans. And these prices and yields result in $1,100 of revenue per acre for corn and $816 per acre for soybeans. And then next, we summarize the normal non-land cost line items in our farmdoc budgets into a variable cost and other cost figure. So the variable cost figure is intended to be comparable to that USDA operating cost figure that we talked about. So in the current budgets for 2022, or in this template budget that we're using here, the variable cost figure is $615 per acre for corn and $338 per acre for soybeans. And this results in a total non-land cost of $758 per acre and $456 per acre for soybeans. And it results in an operator and land return of $342 per acre for corn, or $32 of farmer return on cash rented land for corn. And for soybeans, the operator and land return at $360 per acre or $50 per acre on cash rented land. So now if we look at what happens, we talked about returning to this historic price level of $4 for corn or $10 for soybeans. So if we keep in this new column that was just added here in these new columns for corn and soybeans, we didn't change anything but that price, going back to a $4 price and a $10 price. And you can see that if costs remain at those baseline levels and price drops back to a historic level, results in significant losses on cash rented farmland. And so now if we look what happens if we have historic prices at $4 and $10, but also what if variable costs would go back to that 2005 to 2020 historic level from the farmdoc, from our farmdoc revenue and costs, basically the FBFM historical for that period. And so those numbers would be $408 of variable costs and $224 of variable costs for soybeans. And that would bring us to where even on cash rented land, we would have profits of $19 per acre on corn and $28 per acre on soybeans. So something to think about now is the break-even cost level. So let's say we talked about in those slides with the USDA data that we see price, or USDA is projecting price to go back to this historical average, 15-year historical average, but costs don't get that low. So what is the break-even cost level that it would take to break even on cash rented land with a $4 per acre corn price and a $10 per acre soybean price? And those figures come out to $427 of variable costs or $570 of total non-land costs for corn, or $252 of variable costs for soybeans and $370 of non-land costs for soybeans. And so those are the figures that it would take for a farmer to break even on cash rented land with $310 per acre cash rent. And looking at that, putting that into perspective a little bit, Gary showed this slide earlier. It's the non-land cost per acre to produce corn. So this red line that's been added now is that $570 non-land cost at break even in our $4 per bushel corn price scenario. So this is where non-land costs would be for break even on cash rented land if we moved down to a $4 per acre corn price in those future years. You can see that really since 2012, we've been above that in almost every year, or basically at or above in almost every year. And you can see that that would be a huge drop from where projected costs are for 2022. We'd need to see almost a $200 per acre decline in non-land costs in future years if we were moving back to that $4 price level. So kind of to do a summary of everything we've talked about so far, the increase in income in 2021 is due to some of the highest price levels we've seen since 2012 and above trend yields. Our higher costs and expected lower prices in 2022 are resulting in some downward pressure on net income with the trend yields that we have in the budgets currently. And of course, that could change as we move into next year. And then higher 2021 incomes are likely to put some pressure on 2022 cash rents, as Dale kind of talked about, but also 2022 projected incomes are not as strong, and Dale gave some thoughts on, maybe ways that you could work with a landlord on that. And then long-term profitability is potentially a challenge if we see prices returning to historic averages and production costs and cash rents don't decline. And so, Todd, I'll turn it back over to you.
Indeed, we'll give you just a chance, and Gary and Dale, to take a quick look. Maybe we're running really tight on time, just maybe a question or two you could answer. I do want to remind folks that these are made possible, the Illinois Farm Economic Summit, that is, by our partners. They include the TIA Center for Farmland Research, Compere Financial, Corteva AgriScience, FS Growmark, the Illinois Corn Growers, the Illinois Soybean Association, and Farm Credit Illinois, along with our educational partners, Illinois Extension and the Department of Agricultural and Consumer Economics here on campus. If you're already signed up, and you are because you're here today for the Illinois Farm Economic Summits, you'll get an email soon enough about the rest of these summits. We'll take up supply chain bottlenecks Friday at 11 o'clock. That'll be this Friday. Gary will be back then, along with Nick Paulson, and then Monday we'll talk about farmland values with Bruce Sherrick, and skip Wednesday next week. We'll wrap up, though, on Friday of next week, December the 10th, with a policy update. Nick Paulson, Krista Swanson will be back, and Jonathan Koppas will join us at that time. We do want to thank you, of course, for joining us today. Remember, this is archived on the FarmDoc Daily website, or will be soon enough, that at farmdocdaily.illinois.edu, or you can always find it in that YouTube link at youtube.com/FarmDoc video. Gary and Dale and Krista, are there a couple of questions to answer very, very quickly?
Yeah, we will take these questions very quickly. Land sales at record levels, will that impact our real estate taxes? And actually, we use the land sales data do not impact land or agricultural use value. That will be impacted by an agricultural income calculation, which will be going up because we're going to be having higher prices enter in there for the past couple of years. That is somewhat muted because of the averaging going on, but yes, it is still going to be going up. So it's not the price that's causing it to go up, but land values. Are you anticipating an increase in trend line yields for corn and soybeans in the next 10 years? Yes, we are. And USDA did put those in their long run projections. They're roughly 1.8 to 2 bushels per year on corn and about a half a bushel on soybeans. And again, there's no real reason to expect those not to continue. We appreciate your time today. Fill out the survey as you leave, and you all have a good rest of your week.
Thank you, Gary. And on behalf of Jim Baltz, I'm Todd Gleason. You have a great day. We'll see you on Friday of this week.